Welcome to this video on GAAP Advisors Channel. In this session, we will explore how redeemable preference shares, when issued as bonus shares, should be accounted for under Ind AS. This is a practical case that often arises in group structures, and we will walk through both the subsidiaries and the holding company's perspectives. Here are the facts. A subsidiary issues a redeemable preference shares as bonus shares to its holding company. These shares are redeemable at par after 1 year. In the subsidiary's books, the RPS are shown as a liability and retained earnings are debited. The question is, how should the holding company account for these shares received at nil cost? The central issue is recognition. If the holding company receives redeemable preference shares at nil cost, what is the correct accounting treatment under Ind AS? Should, should they be treated as equity or as a financial liability? Let's turn to the standards for guidance. Ind AS 32 tells us that redeemable preference shares do not meet the definition of equity because they embody an obligation to deliver cash or another financial asset. Ind AS 109 requires that financial instruments be recognized initially at fair value. Together, these standards point us towards liability classification and fair value measurement. So, what does this mean for the holding company, that is parent? Even though the shares are received at nil cost, they must be recognized at fair value. The difference between fair value and the transaction price of nil is treated as dividend income in profit or loss. In substance, the bonus shares are a distribution of retained earnings similar to a dividend but in the form of a financial liability instrument. Let's summarize. Redeemable preference shares issued as bonus shares are not equity, they are liabilities. The holding company must recognize them at fair value, and the receipt of these shares gives a rise to dividend income. These are the three key points to remember. In practice, this has implications for all parties. The subsidiary reduces a retained earnings and recognizes a liability. The holding company recognizes a financial asset at fair value and books dividend income. Auditors and analysts must ensure that their fair value estimation is robust and compliant with Ind AS requirements. This treatment impacts both retained earnings and balance sheet presentation. This analysis is based on GAAP Advisors blog and the relevant Ind AS standards, Ind AS 32 and Ind AS 109. To conclude, this case illustrates how Ind AS principles ensure consistency and transparency even in complex scenarios like bonus issues of redeemable preference shares. If you have any issues on financial instruments standards, submit on gapadvisors.com. Thank you for watching this video and engaging with the topic of redeemable preference shares issued as bonus shares. We hope it added clarity to your understanding of Ind AS treatment. If you haven't already, please subscribe to the GAAP Advisors channel for more technical insights, case studies, and practical guidance. Your support helps us continue sharing knowledge with the wider community.